Okay, started by you. I am Leslie Wing, the tax director.
I'm Karen Curtis. I am playing Miss Carter, the chair.
My name is David Tetro, and I will be playing Mr. Johnson, the Chief Executive Officer.
I am Maeva Hickox, and I am playing Miss Lee, the CFO.
I am Abril Tovar, and I'm Mr. Patel, the General Counsel.
My name is Estella Castillo, and I will be playing two different independent directors. One will be Mr. Smith, and the other one will be Ms. Garcia. And we are exploring a tax-free reorganization for a project group for our federal taxation class.
Thank you all for joining this special session. As you know, we've been approached by Reynolds about a potential combination. Our goal today is to discuss the possible structures for a tax-free reorganization under Section 368 of the Internal Revenue Code. I'd like us to consider the options, their requirements, and the implications for our shareholders and business.
Well, I will start by saying that Reynolds is a strong player, and the combination could create significant synergies, but we need to ensure that any transaction is efficient for our shareholders. Ms. Nguyen, could you walk us through the types of reorganizations available under Section 368?
Absolutely. Section 368A1 of the IRC defines several types of tax-free corporate reorganizations. The most relevant ones for our situation are Type A, statutory mergers and consolidation; Type B, stock-for-stock acquisition; Type C, asset acquisition; Type D, transfer of assets, divisive or acquisitive; Type F, mere change in identity, form, or place of organization; and Type G, bankruptcy reorganization. Given our facts, Types A, B, and C are more likely. Type D is more common for divisive transactions, and Type F is for simple changes in corporate form, not for combinations like this, and we're not declaring bankruptcy as of right now.
Let's focus on the first three. What are the key requirements for each, and how may they apply to us at Reynolds?
Let's break them down. Type A is the merger and consolidation. The requirements include us having to be a merger or consolidation under state law. All assets and liabilities of the target transfer by operation of law. Consideration can be stock, cash, or other property, but there is continuity of interest and business requirements. For tax references, we can use the IRC Section 368A, 1A, and for a statutory merger and consolidation, and the Treasury Regulation Section 1.368AB must comply with state law merger statutes. And the nuances of this type of this reorganization is the target must cease to exist post-merger, continuity of interest, at least 40% of the value received by target shareholders must be acquired stock, which is the IRS state safe harbor. Continuity of business enterprise, the acquirer must continue a significant part of the target's business. And then we have Type B, which is stock for stock acquisition. For requirements, the acquirer must use solely voting stock to acquire at least 80% of the target stock. No boot, which is cash or property, is allowed. Control must be achieved immediately after exchange. And for tax reference, we can use the IRC Section 368A1B, the acquisition of one corporation in exchange solely for all or a part of its voting stock of another corporation if immediately after acquisition the acquiring corporation has control. And control is defined as 80% of voting power and 80% of each class of non-voting stock, which is Section 368C. Nuances is no cash or other property can be used. The acquirer can use its own voting stock or that of a parent in control. Basis of acquired stock is carryover basis. Finally, we have type C asset acquisition. Requirements is that the acquirer must acquire substantially all of the target's assets in exchange solely for all or a part of its voting stock. The assumption of liabilities is disregarded in determining if the exchange is solely for stock. The target must distribute the stock and other property it receives, as well as its other property, in pursuance of the plan of reorganization. And its tax reference is the IRC section 368A1C, the acquisition of one corporation in exchange solely for all or a part of its voting stock of substantially all of the properties of another corporation. Substantially all is generally interpreted as at least 70% of gross assets and 90% of net assets, but facts and circumstances can apply. And for nuances, some cash or other properties can be used if at least 80% of the value is acquired by voting stock. The target must liquidate and distribute the consideration to its shareholders.
Hold on a minute. What are the practical differences for our shareholders? For example, would they get stock in Reynolds, or would Gamble survive as the parent?
In a Type A merger, either company could be a survivor, depending on the merger agreement. In Type B, Reynolds would acquire Gamble's stock and Gamble will become a subsidiary. In a Type C, Reynolds will acquire Gamble's assets and Gamble will liquidate.
What about the continuity of interest and continuity of business enterprises requirements? How do they affect our options?
Both requirements apply to types A, B, and C. Continuity of interest. A significant portion of the value received by Gamble shareholders must be Reynolds stock. The IRS generally looks at least 40% stock consideration, but there's no bright line rule. Continuity of business enterprise. Reynolds must continue a significant part of Gamble's business post-transaction. This can be satisfied if Reynolds continues to operate Gamble stores or uses a significant portion of Gamble's assets in his business.
If we wanted to do a split up or a split off, what would be type D reorganization?
Yes, type D reorganizations are used for divisive transactions such as split ups, split offs, or spin-offs. In a spin-off, Gamble could transfer its assets to two new corporations and shareholders would receive stock in the two new companies, with Gamble liquidating. But that's not our current scenario since we're considering a combination and not a division.
Let's focus on a type A merger. What are the steps and what documentation do we need?
For a type A merger, we would need a formal plan adopted by the board of both companies and approved by shareholders as required by the state law. The plan should detail the parties, the steps, the consideration, and the business purpose. And for a state law merger, we need to file merger documents with the relevant states and all assets and liabilities transferred by operation of law. And we have to have an exchange of stock where Gamble shareholders receive Reynolds stock and possibly some cash if desired, but stock must be a significant portion. And then we have tax filings and reportings. Both companies must report the reorganization on their tax returns. Under proposed regulations, a comprehensive plan of reorganization must be filed with the IRS, detailing all the steps, parties, liabilities, and business purposes.
We should also consider the new proposed regulations, which will require us to document the plan of reorganization in detail and file it with our tax returns. This includes identifying all parties, all steps, all liabilities, and the business purpose. Failure to comply would result in IRS scrutiny.
Okay, but what about the substantially all requirements in the Type C reorganization? If we sold off a business line before the deal, would that be a problem?
Not necessarily. The IRS has ruled that if the assets are sold to unrelated parties and the cash proceeds are transferred to the acquirer, the substantially all requirement can still be met. However, if assets are retained by the target or its shareholders, the transaction may be considered divisive and not qualify as a Type C reorganization.
So if we did a type B reorganization, could Reynolds use a subsidiary to acquire our stock?
Yes, as long as the acquiring corporation or its parent is in control of the acquirer after the transaction, the consideration is solely voting stock.
And what about the basis issues for our stockholders?
In a tax-free reorganization, shareholders take a carryover basis in the new stock received. For Type B reorganizations, the acquiring corporation's basis in the acquired stock is the same as the basis in the hands of the former shareholders.
Okay, so let's summarize. We basically have three main options. We have a Type A merger, which is probably the most flexible and allows some cash, but requires the state law merger and target ceases to exist. We have Type B reorganization, where there's only voting stock and we must acquire 80% or more of target stock, and target becomes a subsidiary. Or we have Type C reorganization. We can acquire substantially all assets for voting stock. Target must liquidate. So we need to weigh the business, the legal, and the tax implications of each one. And I'd like the tax and legal teams to prepare a detailed comparison, including the impact of our financial statements, our shareholders' basis, and any potential pitfalls.
I agree with all of that. We'll also need to coordinate with Reynolds to see which structure that they prefer, and then what makes sense for both sides after that.
Okay, we'll prepare a memo with references to the relevant code sections, regulations, and the IRS rulings and circulate it before our next meeting.
Thank you, everyone. This is a complex decision, but I am confident that we'll find the best path and move forward.
Mic drop. Great job, everybody.